All right, so ladies and gentlemen, let me just do a quick little intro regarding our first guest. Our first guest is Steve Bigalow. Just let's kind of let you know a little bit about Steve Bigalow. He has over 30 years of trading experience. He's also was a broker on a major Wall Street firm here in New York. Kidler Peabody is one of them. Oppenheimer, Town. I don't know if you guys remember a lot of these brokerage firms, but a lot of them are one of the biggest in the industry. He has followed over 50 years of commodities trading. He also holds a business in economics and degree, and right not too far from our New York facility here, Cornell University, one of the biggest Ivy League schools in the country. Bigelow's also been advising professional traders, money managers, mutual funds all over the world. He also has 3 books out there. His first book, Profitable Candlestick Trading, Pinpointing Market Opportunities to Maximum Net Profits. His second book, High Profit Candlestick Patterns, Turning Investors Segment to High Profits. And his new book, not too long ago, that came out in 2010, Candlestick Profits, basically Emotions and Candlestick Signals. So you have 3 wonderful books that Steve Bigelow has been around, and also he's been a great partner of Cybertrade University. Been doing events with Candlestick for over several years right now. He has a very, very big following. He's very, very respected in the trading community and with all the channel partners. So he's got some great content. And once again, just keep in mind, the big thing about the Trading Summit is, which a lot of you guys need a lot of help on, is how to trade in the summer months, because summer's, is a hit and miss, and that's one of our themes that we're going to be talking about, in the summit. So let me pass the microphone over to Steve Bigalow. Steve's going to talk about an hour, and then we're going to introduce our featured presenter from Thinkorswim's going to come on right after him. So, and he's, like I said, and any questions, any comments, anything you might have, feel free to share it in the chat room. The chat, nobody will be able to see everybody else's chat, but all the presenters will be able to read all the chat, and they'll try to answer everyone's questions as much as possible. We have a very, very packed house. They have very limited time, and there's only so much they can share with you. All right, everyone. Without further ado, let me pass the mic over to Steve. Steve, the stage is all yours.
Can everybody, can you see my chart all right? Or my screen all right? Am I coming on with the right one? Uh-oh.
Yeah, Steve, we see everything fine. You can go ahead.
Okay, great. All right, well, welcome everybody. I guess my first question would be, so I know how fast or slow to go, how many people have seen my candlestick presentations in the past? Y for yes, N for no, obviously. Okay, so far, about 50-50, all right. All right. My first comment is, don't bother to take notes because we go too fast. These recordings are available to everybody. And I will try to read your questions. The problem with this darn system is the font is so small, I have to squint. Let me try it over here. That's a little bit better. Okay. The reason we call this system our unfair advantage is because with candlestick signals, there are expectations that we look for after candlestick signals and pattern breakouts. And the reason for that is the Japanese rice traders over 400 years not only identified the signals, but they told us what the investor psychology was that created those signals. So when I first started, as a matter of fact, I got out of the brokerage business because I discovered that brokerage firms didn't have any more idea what was going to make a stock go up or down than anybody else. The philosophy was buy good quality companies with good earnings, good management, hold them long term, and you're going to do all right. Well, as we've seen here in the past decade, that didn't always work. So my biggest bugaboo when I was starting to learn to invest was that I didn't acknowledge that even if you found the best trading system in the world, that would have a 70% winner, that sounds great. But what everybody doesn't kind of address is what you expect. You also expect you're going to have 30% losers. So with candlesticks, not only did it show you where the winners were, but it also told you when you got into a trade that wasn't working, it got you back out. So essentially what we try to do is find the parameters that might take that 30% losing ratio and whittle it down to maybe 28.2 or 29.1 or 27.7. Something that was going to increase our probabilities of being in the right trade at the right time. Now, that doesn't sound like a big percentage difference, but every time we can find something that would create a better trade situation, improve or decrease our losers, that would improve our winners, obviously. And over the long term, that expands exponentially. So the first thing that is going to make high profit returns or give you a good advantage is using the signals with confirmation. And that's just a very simple trading element that we put into our candlestick signals. Is when we're looking for a pattern or a signal, we're looking for confirmation that tells us that that signal or pattern has worked. That gets us into the trade. And hopefully our trade is going to be a strong price move. What we don't want to find is a nice bullish pattern that doesn't confirm the next day. That's why I always, some people say, well, should we be buying on this day? I don't. I'd rather pay a little bit more knowing that it confirmed and went in the right direction. Because when it doesn't confirm, that keeps you out of situations where that trade never worked. You're already on to something else trying to find a good place to put your money. Now, the next major element that we've applied with candlesticks is what we call the T-line. And the T-line is the 8 exponential moving average. T-line is the 8 exponential moving average. Now, the reason candlesticks and the T-line are so highly effective is, number one, the candlestick signals are the accumulative knowledge of everybody buying and selling during a specific time frame. So what the Japanese race traders did by boxing in the open and close is just basically gave us a graphic depiction of what was going on in investor sentiment. And the reason you want to trade investor sentiment, number one, is prices do not move based upon fundamentals. Prices move based upon the perception of those fundamentals. And that's why emotions, the graphic depiction of emotions in the markets is much more important than trying to figure out the fundamentals of a company or soybeans or whatever. So prices move because of investor sentiment. Now, the T-line is not a moving average that everybody uses. Obviously, the 50-day, the 200-day, and the 20-day simple moving averages are things that most money managers, not most, every money manager around the world uses to make their decisions about their portfolios. They actually act as magnets because everybody's going to wait and see what's happening at those moving averages. The T-line, nobody uses that. So what it essentially does is it puts us in a position that tells us that the T-line, this black line right here, is somewhat like a Fibonacci number, a natural number that that is just built into investor sentiment. So when you add the T-line and candlesticks together, you've got a very strong combination. So it makes a very simple rule. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. Conversely, if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. So why is this the advantage? Is because candlestick signals are work off one criteria that never changes, and that's human emotions. So if we can see candlestick buy signals For example, in this chart, we see bullish haramis. And very simply, if we see a bullish harami, a candlestick buy signal, when stochastics are in the oversold condition, and that oversold is when it's below 20, overbought is when it's above 80. And my numbers on the signals, I'm sorry, on stochastics, is 1233. And that's nothing that was anything real sophisticated, other than I spent an hour one time going back and saying, all right, where's the bottom? Does it correlate? What numbers does it correlate with to where the stochastics are oversold? And where's the top? Does it correlate with the stochastics being overbought? So anyways, the more elements we can put into our analysis, which is all visual, is if we can see candlestick buy signals in the oversold condition, and we can start adding other elements like it bottomed out right here or supported right on the 200-day moving average, and we have a candlestick signal. Now, we have candlestick signals and we have enhanced candlestick signals. Here's our bullish harami. There's our doji, and our doji is where they open and close approximately at the same level, meaning there's indecision between the bulls and the bears. But we also have another very simple rule of a doji, which is it's going to move in the direction of how they open it after a doji. So if they open it and start trading positive, we know that this candle right here is going to be the same as this candle right here, or essentially a doji sandwich. If we can calculate, very simply by a visual, that this candle right here being the same as this candle here is going to close above the T-line, we want to be buying. And how long do we hold? Until we see a candlestick sell signal and close below the T-line. And there's one caveat to that trading rule, which is the further away you move from the T-line, the higher the probability it's going to come back and test it. So it tells us that the further we start moving away from the T-line, we start seeing candlestick sell signals, the probabilities are they're going to come back down and test the T-line. So take profits. Now, there's a couple things it could do when it gets here to the T-line. One, it could bounce back up and do a J-hook pattern, which we'll get to later, or it could continue on down. This is part of the emotion aspects that that killed me. I was one, fortunately, before candlesticks, I say fortunately, unfortunately, before candlesticks came along, I was the worst investor in the world. I did everything on emotions. And the candlestick signals just gave me a format to get rid of my emotions. So if I know these basic rules, which are very simple, and they're going to work over and over because human emotions don't change, that if I see a price, now if I was buying here and I was owning, I would hate to take profits, because what if I sold and this thing just kept right on going? This was the Dell of our lifetime, and it could have made me a fortune. So I wouldn't sell, and I'd hold, and I'd hold, and I'd hold until it all came right back to where I bought it. I'm thinking to myself, why the heck didn't I sell up here when I had good profits? Well, now I at least have a format and say, take profits. If it does a J-hook pattern, you can always buy back in. Candlestick signals, especially the dojis, tell you when there's indecision. It tells you what's going on at major support levels. And if it closes above the T-line and trades above the T-line, it's time to be buying. A lot of people say, boy, I don't want to buy a stock that's up 3, 5, 10, 15, 20, 40, 80%. You do if it comes out of a candlestick signal. So if I'm not buying here, which I probably wouldn't be, I definitely will be buying here on a gap up, because what's this tell me? It tells me after this indecision, supporting on the 50, and a close above the T-line, that when they traded up here, they disregarded this downward resistance level. I was more than likely in a very strong uptrend. Anytime I see the signals and a close above the T-line, just tells me to stay long. And there's times where it gets iffy, but if our basic rule is we hold until we see a candlestick sell signal and a close below the T-line, or if we've moved far enough away from the T-line, we can take profits and then buy back if it bounces up off the T-line. But the visual aspects of candlestick analysis is very simple. If we see a candlestick buy signal at the 50-day moving average, what's that basically tell us? Pretty much tells us that if you're an institution and you like this stock and you see it fading back, where do you think you're going to wait to buy? You're going to wait to buy to see if it supports at the 50, and if it does, that's when you're buying. The advantage we have with candlesticks is that we can see exactly what's going on in investor sentiment at those levels. Somebody asked me a while back, how many days does it take for your signals to confirm before you get in? And the answer to that is 0. If we see a candlestick buy signal in the oversold area, especially on a support level, and they open up positive the next day, we're buying immediately, because that's telling us that's what we needed to see as confirmation that the bulls were coming into the trade. That does 2 things for us. 1, gets us into the trade early. 2, if this fizzles, there's very simple rules for stop losses on candlesticks. Over the last 40 years of investing, I often tell people that I've heard every money manager tell you to cut your losses short and let your profits run. The only problem with that is they never tell you how to cut your losses short and let your profits run. Candlestick signals has very simple, common sense elements to it that allow you to do that. If this is a bullish signal and they trade up positive the next day, where should they not close this at all? They shouldn't close it more than halfway down this candle that told us the bulls were in control. Or the Japanese rice traders say the bears are still in control. Get back out of that position. Just very simple visual when to buy and when to stay in. Now, there's also elements that you might come out of a trade because it closed below the T-line. But the other thing that always killed me was if I took profits or got out of a trade, boy, I wouldn't get back in because, geez, I'd look stupid if I sold and then I got right back in again and it went right back down and I had to sell again. Gee, boy, would I look stupid. But now I've discovered that if they close this above the T-line, we're in an uptrend. So if I see a sell signal and then it's negated, get right back in. If this is a 10-point move and I only make 8 points of that, that's fine with me, as long as every time I got in, it was because the probabilities told me I was supposed to be in that position versus out of that position. A left-right combo, gap up, makes this very simple. We're above the T-line. It gapped up again. I don't care whether I'm up 3, 5, 10, 15, 20% when I'm buying. Where's my next likely target? The 200-day moving average. What do we have at the 200-day moving average? A kicker signal. Tells us exactly when it's time to take profits, because it told us the 50 was going to act as resistance. There's our inverted hammer, another one of the 12 major signals. Those of you that are new as far as candlesticks, there's about 50 or 60 signals out there in the candlestick universe, except most of them, even though they work, they don't even occur often enough to take your mental time and energy to learn them. There's 12 major signals, 6 longs and 6 shorts. If you learn those, understand what they look like, and understand what the psychology was that created them, you're going to have the same investment perception as somebody that's been trading in the market for 40 or 50 years. The inverted hammer is one of those 12 major signals. And there's a very simple rule, and this is my statistics, not anybody else's, that if you're in the oversold area, you see an inverted hammer and they open positive the next day, you probably have a 95% probability or greater that you're going to be in an uptrend, which makes the stop loss very simple. If that statistic is right, that we should be in an uptrend, where should this price not move after it opens positive? Back down below this level. If it does, you close out the position because that's exactly where it shouldn't go. The 8 exponential is the T-line. And it works just as well on the bearish side. You see a bearish signal, and another aspect of candlestick analysis is the bigger the signal, the higher the probability there's been a change of investor sentiment. So you see a big bearish engulfing signal, and the next day they're trading it back down below the T-line. You stay short until you see a buy signal and it closes back up above the T-line. Just makes it very simple that if we can see all the elements, and just very simple logic, the Japanese rice traders say if you see a candlestick buy signal in the oversold condition, the probabilities are pretty strong you're heading up. Now, conversely, if you see a candlestick buy signal in the overbought condition, it doesn't mean very much. Or if you see a candlestick sell signal in the oversold condition, that doesn't mean very much. But when all the elements are in alignment, the stochastics oversold, buy signals, and then a close above the T line and a breakout through the this resistance level and a close above the 50, the probabilities are pretty strong that you're going to be in an uptrend. Now, the reason I tell people to use the candlestick charts, we have a lot of adages that people use in investing. One is sell in May and go away. Well, if you did that, you lost a lot of money over the last 2 weeks. The candlestick charts tell you exactly what's going on in investor sentiment at any given time. So I tell people, don't let what supposedly the adages tell you. Do what the chart tells you. The Japanese rice traders have one simple statement about candlestick charts. They say, let the market tell you what the market is doing. That way you don't have to listen to anybody else. You can see yourself what the charts are doing. Candlestick buy signal, close above the T line, puts you in a position where the probability of being in the right trade at the right time is extremely high. There's that bullish engulfing signal, inverted hammer, close above the T line, doji sandwich. Another element of a doji sandwich is not only does it get you in the position correctly, but usually the aftermath is there's going to be a strong move after that. What is the T line? The T line is the 8 exponential moving average. And just very simply, if you see a candlestick buy signal and a close above the T line, you stay long until you see a candlestick sell signal and a close below the T line. Is it time to get back in? Well, if you see a candlestick buy signal like our Morningstar signal, you get back in. Once again, if I only make 80% of this move because I took profits and then got back in when it was time to get back in, that's fine with me. I'm not so much interested in squeaking out by buying at the absolute bottom and selling at the absolute top. I'm more interested in making money with a high degree of probability. The time frame on candlesticks, remember our very basic statement that the candlestick signals are the accumulative knowledge of everybody buying and selling during a specific time frame. The candlestick charts work just as effectively on a 1 minute, 3 minute, 10-minute combination as they do on a daily, weekly, or monthly, depending on the time frame you're trading. I used to trade the E-minis using that 1 minute, 3 minute, 10-minute combination. Right now I trade commodities, whether it's the soybeans, cattle, or the meats, using a 1 minute, 5 minute, 10-minute combination. If I'm trading the dollar or the euro, I'm usually using a 5 minute, 30-minute, or hourly combination. My stock trading is swing trading. I'm usually in anywhere from 2 to 10 trading days, so I'm using the daily charts. Has the 8 EMA, how was the 8 EMA determined? Was it back tested? Domino, I'd say it'd be back tested and that we've been using it for well over 5 years and it works extremely well. And the next thing is I tell people don't take my word for it. It's very simple to put the 8 exponential moving average on your charts. Just watch it and see if it doesn't work. So if we see something like a doji at the T line, makes it very simple. That we know the simple rule of a doji. It's going to move in the direction of how they traded after a doji. So if we see dojis and they start trading a positive the next day, we can be buying because we know it's going to close above the T line. Additionally, if we see a doji at a major support or resistance level, we know it's going to move in the direction how they open it. So if they open this positive with it trading right here on the 50-day moving average, which before was acting as resistance, we know it's not going to act as resistance. We can be buying at that point, even though our stochastics are up here in the overbought condition. It tells us that the resistance level is not acting as resistance anymore. We can find very simple trade setups that put you in high probability situations. There's our bullish engulfing signal. Notice how everything's starting to support on the 50. Now they closed it just above the T line and did a doji. Makes this very simple. If they open up positive the next day, we want to be a buyer because what's our overall chart tell us? If they start trading this positive, we're in a trend channel and the next target is up here somewhere likely. If one doji means indecision, a series of doji means greater indecision. If we can see a series of dojis occurring in the oversold area, and then they take a big move up above the T line, we can stay long. This is just very common sense setup that after this indecision, they've made that decision, and that decision is usually going to last for quite a while. Where do most people sell? They panic sell at the bottom. Where do most people buy? They buy exuberantly at the top. And the graphic depiction based upon candlestick charts will illustrate that. So it allows you to start looking, again, being the worst investor in the world, this was usually me selling down here and buying up here because I finally got confidence enough that they were taking this up. And that's most people. I say most people. I put myself in the category of most people before candlesticks came along. Now I know when to be looking for the buy at the bottom and looking for the sell at the top. This is what I'm looking for. Chart patterns. There's this our fry pan bottom. There's our slow curve breakout. There's when it's time to take profits. A hanging man. And notice how far away we are from the T line. And also notice what's happened right here. They've gapped this up. So what's that tell us? Where do most people buy? They buy enthusiastically at the top, or exuberantly at the top. So if we see a gap up in the overbought condition and you've moved away from the T line, get ready to start taking profits. It just acts as a very simple alert. What is this all telling me? That there's indecision down here. Get ready for getting in on the next buy signal. If I'm missing your questions, it's only because the font on this system is so small, I have a hard time reading it. So once I get through, I'll come back and make sure I get everybody's questions. So here's that same situation. If I see a doji right here on the T line after some reversal, very simple. If they open this positive the next day, I want to be a buyer because then I have what I call kind of your scoop pattern. There's a big flat handle with a scoop, which usually has a slingshot effect, taking things to the upside. The candlestick signals are usually bought when things are in the oversold condition. Again, it's very simple. If you see a candlestick buy signal when stochastics are oversold, the probabilities are pretty strong that there's been a reversal. On the other hand, if you see a fry pan bottom, and a fry pan bottom is the Japanese rice traders identifying investor sentiment not doing anything, just a very slow rounding curve. You couldn't trade this if you wanted to. But at the beginning of that fry pan bottom, if they break it out, notice where your stochastics are. They're not down here in the oversold area. They're now in a situation where the enthusiasm has come back in. The result of a fry pan bottom is a very strong price move. And it can be very easily seen. Notice our doji gap up. A doji followed by a gap up is what we call your best friend, because that is going to make you, that one pattern alone will make you a fortune, because that basically tells you from this indecisive day, they gapped it up and moved positive, telling you that was a very, they've made up their decision with very good strength. So anytime I see this right pan bottom setup, I'm ready to buy as soon as it breaks through, because that tells me there's going to be a strong move to the upside. Anytime I can see a fry pan bottom and they gap it up out of this range, this is my expected move. It's a very strong price move. Where do I start taking profits? When I see them sell signals. Now, there's also another candlestick pattern, which we call the J-hook pattern, which is just a very simple hook pattern, and the prerequisite is a very strong price move. So we call this the classic, where you have a fry pan bottom, strong price move, profit taking, and then we get right back in. Notice our doji sandwich telling us there's going to be more upside. We also know that this fry pan or this J-hook pattern has three waves to it. Wave 1 and wave 2, then wave 3. We also know that wave 3 is going to be equivalent to wave 1, which makes it very easy to analyze whether we want to be in that trade, number one, or number two, if we know what our upside potential is, makes for very effective option spreads to kind of increase the value or increase our percent return. So using the T line and the candlestick signals makes it very effective for showing you when to be in, when to be out, when to be in, when to be out. This is not rocket science. I tell people that All you have to do to analyze candlestick charts is be able to see. You don't have to know formulas. You don't have to know all the technical stuff out there. I tell people it's just like the old couple getting ready for bed, and she's standing there in front of the mirror naked, and she says, "Look at me. My face is wrinkly. My arms are scrawny. My butt's skinny. My legs are spindly." She turns around to her husband and says, "Is there anything nice you can say about my body that would make me feel good?" He goes, "Well, your eyesight's still pretty good." So as long as you can see, you can make lots of money using candlestick analysis. Also, if you're using a trading technique that's working for you, change it over to candlestick charts, and it'll be a lot more effective. You'll be able to see a lot more clearly what's going on in your price movements. Breaking out of this fry pan bottom, strong price move, J-hook pattern, next price move. And this is what we're looking for right here, is the fact that they couldn't get down below the T-line. It curls back up, and this is the type of price moves. And how long do we stay in this? As long as there isn't a sell signal and a close below the T-line. Very simple rules. If we're this far away from the T-line, where should the price not come back to? Basically, we put our stop at the previous day's open. If it comes back down through there, that tells us the bears are in control. They're probably coming back to the T-line. You can always buy it back if it bounces off the T-line. The opposite of the fry pan bottom is the dumpling top, where when it starts rolling over, the same results. There's going to be a very strong downtrend. So if I can see a dumpling top setting up, I can see that it failed to 50, closing below the T-line, I want to stay short until I see a buy signal. Or if I see the next dumpling top, notice what's happening right here at the support level. A big candle, a doji. If it opens lower, what's our simple rule of a doji? It's going to move in the direction how they open it. So if they do a doji sandwich, moving down this much, means they're not supporting here. I've probably got another leg to the downside in progress. Slow curve. I like to show this to people because I've made a fortune off a slow curve. A slow curve is the same as a fry pan bottom, except it usually occurs when the uptrend's already started. And notice what happens when they break out. It's a very powerful move to the upside. So again, that gap up through that resistance level tells us very important information. Everybody and their brother knew that this is probably a little resistance level, but they gapped it through. That told us that there was not going to be any concern about buying going through that gap up process. J-hook pattern confirmation. Again, this is why we can see what the nature of the candlestick signals are. Dojis, inverted hammers, spinning top, indecisive pullback. We get ready for the next move to the upside. And there's that classic fry pan bottom breakout, strong price move, pullback, indecisive trading. There's our left-right combo, which is a doji followed by a bullish engulfing signal. They couldn't close it below the T-line. If we miss this move right here, we can already calculate what this move is going to be. It's going to be basically this move right here. We can either be buying right here, knowing that we have a J-hook pattern, which does two things for us. If it fails and closes back below the T-line, we're right back out with a very small loss. If it goes through, we know we're in our next move to the upside. Or, more conservatively, we can buy up here, knowing that it did break through. Gave up a little bit of the returns, but had a much higher probability we were heading in the right place at the right time. Doji sandwich, more upside, which tells me we're going to stay above the T-line. That's different than a flutter kicker. A flutter kicker, doji sandwich has a bullish candle, a doji, and a bullish candle. Flutter kicker has a bearish candle, then they gap it up the next day above the previous day's open. And then what's our simple rule of a doji? They're going to move it in the direction of how they open it. So if they open it positive and start trading it positive, if we took this little doji out of here, we essentially have a kicker signal, which is the strongest of all the candlestick signals. If we can see the resistance level, we can see the buy signals, we can see the pattern, kind of a scoop type pattern, we want to be a buyer, knowing that the probabilities are pretty strong we're in the right trade at the right time. Again, the best friend is that doji followed by a gap up, especially a gap up as it closes above the T-line, tells you you're going to be in a good, strong uptrend. We make tons of money by seeing what's going on in investor sentiment, and then they gap it up, especially coming out of the oversold area. That not only tells us they are very anxious to get in this trade, but they're going to get in here with a lot of force, which usually means there's going to be a strong uptrend. Just a very simple visual analysis. Doji, gap up, you're going to have a strong uptrend afterwards. So when we have pattern confirmations, this is what we call the blue ice failure, where somebody's fallen through the ice, they come back up, see if they can find the hole they fell through. If they can't, which we can see that they did, doji failure, they're coming back down to the bottom of the pond. We can be buying long, we can be selling short. This gives us a much better visual roadmap of where we should be buying and selling. Inverted hammer dojis, bullish confirmation, and where did it do it? Right here, smack dab on the 50-day moving average. What type of pattern do we have setting up? Probably a J-hook pattern. There's our doji sandwich. What's that imply? There's going to be more upside. If that implies there's going to be more upside, telling us they're breaking through here, it tells us we're probably in wave 3, same magnitude as that move right there. There's that scoop pattern. Flat handle, doji sandwich telling us there's going to be a whipsaw or a slingshot effect to the upside. Just a very easy trend analysis. There's that little fry pan bottom breakout. There's that slow curve breakout. Then you moved away from the T-line, took some profits. There's our inverted hammer, buying back in. Just gives you a roadmap of when to be out, when to be in. And obviously, we're in an uptrend, so we're starting to look for when a pullback is over, which buy signals start to confirm getting back in again. It also helps us take profits. And also, I've covered up my clock, so you're going to have to tell me when we're getting near time to start wrapping things up. Taking profits. Also, we know the simple rule of a doji or of the T-line is the further away you move from the T-line, the higher the probability it's going to pull back and retest it. So anytime I start seeing things move away from the T-line, we have about 15 minutes, okay. The further we move away from the T-line, I'm ready to take profits because they're probably going to come back and test the T-line. I can always buy back if it does a J-hook pattern. But anytime I have a big price move based on there's that slow curve breakout, then I start looking to see what type of signals we have when we're this far away. If I'm starting to see bearish haramis, I'm starting to take profits. What's my worst case scenario? I take profits here. I put a buy stop right back up here. If the profit taking's over and they take it back up, I'm still in the right trade at the right time. We made a lot of money on this trade not too long ago, buying it coming out of the fry pan bottom at around 12.38, started selling it up here in this range. But notice how far away we were moving from the T-line. We have a whole nother training session showing this little line right here, which is a 3 EMA, which makes it very simple. If you're starting to move away from the T-line, the 3 EMA, the 3T starts kicking into effect. So when we start moving up here, the daily chart tells us we're way overbought, so we flip to our 10-minute chart. First day we took profits right here. But notice what the 10-minute chart did right here. It came back up through the T-line. We're buying back again. Why would we be buying back a stock that's way up in the overbought area? Because we know what the result of a fry pan bottom is. It's a very strong breakout. So even though we took some profits here, we bought it back, and we got another big day, which was this day, and then closed it out the next day. So again, this isn't rocket science. This is just doing what the Japanese rice traders have shown us is the expected results out of signals and patterns. Anytime we start moving away from the T-line and see sell signals, we start taking profits. If we're up the overbought condition and they're gapping it up, very simple stop loss or profit-taking stop losses. If it opens here and starts trading positive, after gapping up from the previous day, we put our stop right here. It shouldn't come back down through this level. If it does, it's going to create some sort of candlestick sell signal. If it opens here and immediately starts selling off, we put our stop at the previous day's close. It shouldn't come back down through that level. Anytime I see that gap up, first of all, it shows us when to buy, shows us when to sell. This is not difficult. This is all based upon what investor sentiment does day after day, week after week. year after year, century after century. And it's not going to change for the next 400 years either. Just simple buy setups and puts us in situations where, whether you're an option trader or a stock trader, it creates the ultimate entry strategies. There's our doji, potential doji sandwich. If it opens positive, what's the next day? What's it telling us? It's probably going to have the same magnitude move as that, which means it's going to get through the 200. It's also telling us the fry pan bottom is breaking out. Do we always get big price moves like this? Not necessarily, but the nice thing about candlestick signals is it puts us in positions where we're going to have a much higher probability of being in the big move situation. It also tells us, if we're short, tells us when to cover and when to re-short. That if this was the signal, the bullish harami, that told us that the bulls are starting to step in, where should this not trade? It shouldn't trade back below the low of that bullish harami. It tells us the bears are still there. Now we've got a bearish J-hook pattern in progress. There's a trend kicker. There's our Morningstar signal, trade up above the T-line. They opened it here, closed here. The next day they gapped it up and started taking it right back up again. That trend kicker tells us there's going to be a lot more upside. Tells us when to buy on a breakout. Tells us where to put our stop, that it shouldn't come back down below the previous day. All right, let me start flipping through here. Again, these are all powerful signals, and these aren't cherry-picked signals. Rest assured, I will find another 10 strong signals in the market from Friday. They're there every single day. You can set up your scans. I had set up the scans so that in less than 20 minutes each afternoon, I can scan through the 7,800 trading entities out there in the market and come up with the best 2 or 3 trades for the next day. My game plan was that I would trade for 20, 30 minutes in the morning, put my positions on or take them off, go play a round of golf, come back with 30 minutes left at the end of the day, and either add or close out positions, which was a great trading strategy, except I haven't been on a golf course now for probably about 6 years. I'm looking for that breakout situation that can create a very strong price move. That was a recent recommendation. We were ready. We were buying calls on CONN because we had a doji that if it opened positive the next day, we were buying right here on the doji because it had a very simple trading situation. If it opened positive, it was probably breaking out big. If it opened negative, we closed out the position. Recent recommendation on AMKR, kicker signal, breaking out through this level, above the T-line. Why do we still own it? Because we haven't seen a candlestick sell signal and a close below the T-line. Recent recommendations a couple of days ago, CMRX. Why? Because we had a J-hook pattern that hit the 50, came back to the T-line and the 200, came back up through the 50. If this was wave 1, wave 3 should take us up into this area. Again, this is not anything more difficult than understanding what human nature does day after day, time after time. So to go with Fausto's concept of what to trade during the summer, the nice thing about candlestick signals is it instantly will tell you which sectors or which stocks are getting strength, which ones are getting weakness, so you can trade accordingly. It also works very effectively for analyzing what the trends are doing. So the nice thing about candlestick signals is because it has such high degree of expectation results, it basically takes your emotions out of your trading. So I think what Pat has set up for a special for everybody is we've got an ebook that goes through how each of the signals keeps your emotions out of your trading. And the reason I did this was because, once again, I was the worst investor in the world until candlesticks came along. And that's the biggest problem that most people have. Even though you might see the best trading program in the world, if your emotions aren't in the right place or use it effectively, it's not going to do you any good. So we've got this ebook that we usually sell for $129. We're putting it out for $17. Fausto, do you have a link for everybody to get to go to this special. Oh, you do not? Okay. I'll have to grab it here in a second. Let's see. I don't know whether I can do this. I can. Let's try this. Try that one. Now, let's see. Is that it? Okay. There we go. Okay. Anyways, the reason we're putting it out for 17 bucks is through the years, I've discovered that everybody knows about candlesticks. They just don't know how to use them. A lot of people say there's too many of them to learn, and they don't always work. And that was the same story I heard 30 years ago. And I always came back to one simple premise, that if they didn't work, we wouldn't be looking at them today. One of the basic rules of Wall Street is if something doesn't work, it disappears very quickly. There were too many of them. And as I discovered on my own research, that there's only about 12 that if you learn those 12, you probably have a very good grasp of what goes on in price moves. And again, you can take the candlestick charts and overlay them on whatever you're using right now, and it'll make everything seem or be a lot more clear. Okay, with that, let me see if I can read some of the questions. Let's see. Yeah, they have scans. We have a chat room that is open all day long. We usually have around 300 members in there. We've got people that can write formulas for any of the softwares out there. We've written formulas for Metastack, for TC2000. I'm pretty sure a lot of our formulas are on Thinkorswim and E-Trade, Ninja Trader. So they're all out there. Plus, they're on our website. If you need to go get them, you just copy and paste them and stick them on whatever, or rewrite them to fit the verbiage of whatever you're looking at, whatever your trading program is. Using 15-minute charts, the stochastic speed line and candlesticks look right. Should I look at the 10-minute or 5-minute chart before placing a trade? What I usually do is when I'm trading, especially commodities, off the 10-minute chart, if the 10-minute chart looks like it's starting to set up, I flip down to the 5-minute chart, because what I want to see is if the 5-minute chart is all of a sudden overbought and the 10-minute isn't, that means more than likely they aren't ready to break out. That the 5-minute chart, if it's going to start pulling back, means the 10-minute chart isn't going to go into effect. If the 5-minute chart is looking good, then I flip down to the 1-minute chart to make sure that the 1-minute chart isn't overbought. And if it still looks good, then I go ahead and place the trade. And we do sessions for the members where we do a whole evening on entry and exit using the T-line, the 3T line, the 5-minute chart, and 10-minute chart combination. Again, all of these factors are to improve the probabilities of being in the right trade at the right time. Where do I set my stochastics at with a 3? And is it simple or exponential? Stochastics, the stochastics are 12, 3, 3, and they are slow stochastics. Again, the stochastics are only telling you where you are in the in the trend. Let's see. Okay, if they're the EMAs, the 8 exponential moving average is the T line. The 3 exponential moving average is the 3T line. And then the moving averages that most people use, the 200, the 50, and the 20 are all simple moving averages. Okay. I guess that's about it. thank you, everybody, for letting me participate this morning. Hope everybody's having a nice summer morning. Fausto, thank you for the invite. We'll see everybody in the chat rooms.
Steve, thank you very much for coming here, and